Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
Hey everyone, welcome into another episode of The Financially Free Investor. So today we actually missed the real estate rapid fire episode with Jay Addis. I was out of town last week. He's out of town this week. Kind of tough to sync up and do this. We went on a road trip with our family up to Yellowstone, and then we went and saw Mount Rushmore and came back. It was a great time. Love the passive income that comes in to be able to do fun stuff like that with the family, make memories that count. So yeah, anyways, today I'm actually switching around the topics that I kind of had scheduled for today's episode, and this will come out Friday, June 24th. And I wanted to chat about the real estate market specifically. So kind of a recap, if you haven't been paying attention, the stock market is down almost 20% from its all-time highs. Crypto is down significantly. I mean, today, let's check where Bitcoin is at as we speak. A lot of people are hurting from stock market correction, crypto market correction. And yeah, I mean, I don't have a ton in stocks or crypto, but I mean, Bitcoin's at 19,000 right now, which I'm not a Bitcoin guy because, I mean, when was the last time you went to, stay out of the rain or a snowstorm and did it inside of your Bitcoin, right? Like, I get that's kind of a joke, but not really. I just don't think it's really a store of value like a lot of people think, and too volatile for me. I'm probably too emotional. But anyways, back to real estate. Is 2022 the next 2008? That's been on my mind a lot lately. And I don't know. It's going to be interesting to see how this all plays out. So kind of give you guys a recap on where we're at here in Salt Lake City's market. We've had record growth for 5, 6, 7 years here in Salt Lake. Great appreciation. Rents have gone up. A lot of good stuff is happening. There's good development. We've had a lot of out-of-state buyers come in, which has helped push the values up. But I mean, relatively, we're a relatively safe, level-headed community and economy, and we're well diversified. It's not like we have one employer for most of the people. Like, there's a lot going on here. That said, I mean, gas is $5.20 a gallon right now. Diesel's almost $6 a gallon, and it seems to be no end in sight. Inflation is, the CPI index is 8 to 9%. I believe true inflation is probably closer to double that. Stuff is just insanely expensive, and the Fed just raised 75 basis points to try to slow down this crazy inflation we're having. But, I don't think it's due to the economy just being on a steamroller. I think it's because of all the supply chain issues we had. And then, oh, by the way, the government printed just an obscene amount of money, trillions and trillions of dollars. And that gets released into the economy, and it's supposed to stimulate the economy, which it did. But then 2 years later, they're shocked that we have runaway inflation. Well, anyone with half a brain could have told you, if you're playing the game of Monopoly, and instead of every time you pass go, you get $200, you just increase it, and all of a sudden everyone gets $2,000. Well, people start paying more for properties, because they've got it. Why not? And they start, just bidding more and caring less about little expenses. And I think that's kind of where we're at right now. A lot of people have been loose. The market has been super frothy. I mean, we were listing properties, fix and flips for the past 2 years. And, when we'd buy it, let's say we thought, hey, this will be worth 700,000 when we sell it, and we go and list it at 725, and we get multiple offers and it gets bid up to 750 or 775. And because there's just nothing on the market. So people are desperate to get whatever they can. And that became normal. And I think a lot of investors got used to that. And now I think we've seen all of the froth come off the top of the market. So we are no longer seeing multiple offers across everything. Occasionally, you get a home that's priced really well and you'll get multiple offers, but it's 2 or 3, not 20 or 30. And we're starting to see sellers get realistic on prices. Some of them are still high in the night, thinking they're going to get these crazy, obscene, doesn't make sense kind of prices. And that's okay. I think you get those in any market. But I mean, interest rates right now for owner occupied houses are high fives, low sixes, which is honestly higher than I've seen in my almost decade of real estate experience for owner occupied, right? Non-owner occupied are higher than that. We're working with a couple of our lenders that we do a lot of business with, just total side note, to do what's called a 2-1 buy down. So we'll go negotiate, $15,000 in seller paid closing costs. And then we take that 15,000 and apply it towards a 2-1 buy down. So if a normal interest rate would be 5.5%, it's going to be 2% lower the first year, 1% lower the second year, and then years 3 through 30, it's the full 5.5%, on the hopes that we can get some of these buyers into homes and they'll qualify for the full payment amount. It's not like 2008 where you didn't have to. They'll qualify for the full payment at 5.5%, but the first year, you're saving $700 a month in interest for the first year. And the second year, you're saving $350 a month or whatever the numbers end up being. The idea is, though, that hopefully interest rates come back down at least into the 4s. And we're able to have them refinance in a year or two when we can get them a rate in the 4s instead of high 5s, just to keep it affordable. And the other side of that coin is, if interest rates continue to rise and we start seeing rates in the 8s, 9s, 10s, which, by the way, guys, on a 70-year historical average is not unheard of. 7% is the average interest rate for a home loan over the last 70 years. And that's per Wells Fargo data. I get an update every single month. There's lots of levers and things you can manipulate to make deals make sense right now. Our inventory in Salt Lake County has risen to, in 2020, in June, we started seeing a decline. So when COVID first hit, we saw a ton of stagnation. So, what normally would have sold in 3 weeks, all of a sudden it was just sitting. There's a lot of fear in the market. Everyone, of course, thought it's the zombie apocalypse. I'm going to get this COVID thing and turn into a zombie, right? No one knew what was going to happen. So there was a lot of fear and uncertainty. And right now kind of feels the same way. There's talks of a recession, but there's high inflation, runaway inflation even, and just no one knows what's going on. So it's like no one is transacting. And I think overall, long-term, if you're in a good market, I wholeheartedly believe in the Salt Lake market for a number of reasons. Now is a great time to be buying because you can negotiate deals. You can find sellers who are motivated. I'm not going to call them scared, but you can definitely find motivated sellers that are willing to play ball right now and figure it out. And the cool thing is interest rates are a one-way bet. So if you lock something up, buy it, your interest rate's 5.5%, and interest rates go down sometime in the next 2 years, we can refinance and lower that payment. And it's not like you're going to have to lower rent to the tenants if rates go down, right? They'll keep paying what they're paying. So at the end of the day, buyers are being rewarded right now. And now more than ever, it's important to make sure that we're looking at deals, making sure they make sense. And if rates go down, you can refinance and there's more upside, then great. But we are only buying quality deals right now in locations that we'll want to hold for the next 5 to 10 years. So, this is what true investing is all about. I feel like a lot of people jumped into the market and they've been speculating for the last 2 years because we've seen 30% appreciation. Guys, that is unsustainable and unrealistic to buy something and a year later have it be worth 30% more. So I think what we've seen is a lot of froth coming off the top of the market. I don't know if this is like 2008. Honestly, there's all the refi business for mortgage lenders has dried up. However, everyone that's buying a home right now is very well qualified. I was listening to a talk from a guy at the Kem Gardner Institute at the University of Utah talking about housing. And biggest thing he said that was different now versus 2008 was the average credit score in 2008 was like mid to low 600s. The average credit score now is well over 760 on that's purchased data for mortgages. So people who are purchasing homes are arguably more qualified now. And I think we learned a lot of lessons in 2008. I also think that all of the eviction moratoriums and everything that happened, that gave people a lot of options that had no reserves. They didn't know what they were doing, landlord by default, whatever. That really stopped a lot of evictions. And interestingly enough, whether you agree with it or don't, it happened. That's another reason why I'm very bullish on Utah and Salt Lake County is high demand for the most part. It's a great area. Our eviction moratoriums weren't that bad. It wasn't the extent of, other, call them more blue states, California, New York, New Jersey, where people still haven't paid since the pandemic and you can't get them out. So you at least have a pretty good shot here. With that said, things I'm doing now, this is just me personally, based on where my portfolio is out. This is not investment advice, but I'm still buying. We're just pretty selective with the deals we take on right now. I have more in reserves than I would have a few years ago. And part of that is because when COVID hit, I was pretty lean on reserves. I mean, I had a few months worth of reserves, but not maybe a full 6 months, including all the mortgage payments we have. But right now we have a little bit more cash than we probably need, just because I want to be able to ride out whatever happens. And I don't want to be forced into making decisions based on, no income or not being able to service a property's payment or whatever that is, partially because of what happened in 2020. I sold a couple of properties that I wish I wouldn't have. And, I didn't make any money on them. I lost money on one just because I needed some liquidity. So this time around, no matter what happens, I've got a little bit extra cash that we're just going to sit on. Courtney and I have kind of already talked about it, and that's our game plan. But if the right deal comes up, we have some cash ready to deploy for the right deal as well, because we're closing on a duplex in a couple of days, a fourplex. Actually, we'll close the day that this releases on both of those. And, at the end of the day, I think in 10 years, owning more assets is better than not. Right now, buyers are being rewarded. Everything I've got under contract, we have negotiated seller paid closing costs and arguably better deals than we probably would have gotten the last 2 years. And rents are going up. I think we've kind of seen the top end of where rents are at. A year ago, it was crazy. We didn't even know what things would rent for because rents were going up so fast. I feel like they've stabilized a little bit now, which is really good. And the same things, the things that are working now are the things that have always worked, which is good, solid deals, value add, something you can go in, fix it up, make it worth more, solve a seller's needs. So guys, the title of this podcast is going to be a little bit clickbaity because everyone is so nervous right now. But at the end of the day, we have a housing shortage. Since 2008, so many builders went out of business. Everyone knows what happened in the past. Today's market is completely different. And while I don't think we're going to see, prices decline by 30, 40, 50% like we did in 2008, I do think there's going to be some opportunity in the next year or two as, we see people, as we're hitting hard times, all the froth has come off the top of the market. And we're going to start seeing truly skilled real estate professionals excel. And I am super excited because all of this information that I've accumulated for the past 9 years, I feel like has led me to this point where we are ready to go and we're going to buy good deals and we're going to operate good deals. We're going to come out of this way better off than I probably would ever imagine. But you can do the same thing by continuing to listen to stuff like this, by improving yourself. I had a buddy text me the other day and he's like, "Hey, should I throw $100 in this cryptocurrency?" And I was like, "No, you shouldn't." And he's like, "Well, but if it goes to this, then, I'll make $124,000. And I was like, "Dude, you'd be better off paying $120 to go learn how to flip homes by taking a course and learning how to buy rental properties, because that is the true investing where you're adding value, especially in real estate." And so right now, guys, if you're scared to invest, if you're sitting on cash, if you're waiting for something to happen, that's great. But I would say buyers for the next 6 to 9 months are going to be rewarded. They're going to come out on top in the next 5 years as the real winners, is the people that bought when there was fear in the streets. And the reality is, we don't know what's going to happen over the next 2 or 3 or 4 years. This could be the new 2008. It could shake out in a completely different way that we're not thinking about. Our currency could completely collapse. And the reality is, like, whether you have cash in the bank or you own real estate, everyone's in the same boat together, right? But if things continue to trend the same way they have, I think, for the last 200 years, odds are pretty good that you buy a good asset in a good area in 10 years, you're not going to regret the decision to buy it and hold on to it and place good quality tenants in there, even if it might be a little tight the first year or two. My guess is, and again, this is not investing advice, go do your own research, but my guess is there's going to be opportunity in the next few years where, I think the economy is really going to hit the brakes because of a lot of different factors out in the world right now. And money's not going to flow quite as freely, but there's going to be tons of deals. And so if you have the knowledge, the know-how to operate good deals, you're going to be able to make things work in any market. So with that being said, guys, I don't think 2022 is the same as 2008. However, I think it rhymes, history rhymes and repeats itself. Or the saying is, history may not exactly repeat itself, but it rhymes. Kind of feels like that. So I think there's going to be a lot of opportunities. I don't think we're going to see a lot of foreclosures. Just looking at foreclosure data, you'll see these articles that say like foreclosures are up 150%. Well, yeah, of course they are, because there was a moratorium and you couldn't foreclose. Right. But if you look at like maybe a 5-year history, they're really not, ticking up at a crazy percentage. The media is just trying to get you to, the clickbait stuff. They're just trying to get you to tune in. At the end of the day, go buy good cash flowing assets. And in 5-10 years, as inflation continues to go up, real estate typically hedges really well against inflation. Rents are going to go up, I think, at a higher click than 3%, just due to inflation. Gas costs more, everything costs more, insurance is costing more, taxes are more. And so, rents are, I'm kind of baking in 7 to 9% annual rent increases for the next few years, and then kind of going down to the normal 3% that we usually bake into our assumptions. But when you're looking at deals, look at them through a 10-year lens, guys, and look up your historical appreciation for whatever city you're investing in. You can find that by going to FHFA.gov. It's the Federal Housing Finance Agency. They come out with a quarterly report. I'll go over one in a later podcast, but a lot of good data there. Look at the data. And right now is the time to be investing, because everyone is scared. And I think everyone's so scarred from 2008 that we just think it's going to naturally happen again. But I don't think it will. I think we might see a modest 10 to 15% reduction in prices, but that's good, because we had 30% appreciation. So that's a lot of the froth coming off the top of the market and things getting priced to really probably where they should be. But overall, over a 10-year period, I think rents are going up, house prices are going up. And best thing you can do is go and borrow at 5% when we're having 9% inflation, because you're paying that back every single year with cheaper and cheaper dollars as the asset goes up in value. And it's a great strategy to create long-term sustainable wealth. None of this get rich quick stuff, but over 5-10 year period, you can absolutely achieve financial freedom. So hope this helps. Hope you guys enjoyed the conversation, and don't get sucked into the clickbait articles. So we'll see you guys.
Thank you for joining me for another episode of The Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.